All right, let's pull back the curtain on one of the most critical and honestly most misunderstood parts of any real estate deal, the earnest money deposit. For an investor, it's the key that gets the whole thing started. But for the person funding it, it's a high-stakes game of risk and reward. So let's break down exactly how this secret engine works.
So, picture this. You found an amazing property, you've negotiated the perfect price, the seller's ready to go. What's the one thing, the single hurdle that kills more deals right at this stage than anything else? It's not finding the deal. It's not the negotiation. It's all about having the cash you need right when you need it most.
Yep, that's the one, the Earnest Money Deposit, or the EMD. This one little requirement can completely derail a fantastic opportunity if you just don't have that liquid capital ready to deploy. It is, without a doubt, the ultimate bottleneck in so many deals.
So what is this thing really? Well, think of it as your promise, but in cash form. It's a deposit you put down to show the seller, hey, I'm serious about this. Now, this money doesn't just go into the seller's pocket. No way. It sits with a neutral third party in an escrow account, just waiting until the deal closes. It's what legally and contractually locks in your spot as the buyer. But what happens if you don't have that cash just sitting around? Well, that's where a very, very specific group of financial players steps onto the scene. They've created an entire ecosystem around one thing and one thing only: funding your EMD.
The world of EMD funding is its own little universe. You've got everybody from private individuals and hard money lenders to these super specialized professional capital desks. Their entire business model is built around giving you this short-term cash, and they do it for either a fee or sometimes a piece of the action. They are for sure the partners that keep the deals flowing.
But listen, getting this money isn't a sure thing. Before any funder is going to put their own capital on the line, your deal has to survive a pretty tough test. I like to call it the gauntlet, and that's the underwriting process. This is where they figure out if your deal is a surefire winner or a total dud. And their approach, it's super methodical. It's basically a 4-step checklist. First, they just vet the basics of the deal. Then, they dive deep into the numbers to make sure there's enough profit, enough spread for everyone. Third, they check out your exit plan to make sure it's solid. And finally, and this is so crucial for wholesale deals, they have to verify that you have a real committed end buyer lined up.
The numbers really do tell the whole story. A funder looks at this and sees a purchase price of $200,000 and an after-repair value of $300,000. That's a really strong potential right there. The investor's profit, their assignment fee, is $25,000. So the big question is that enough spread to cover the funder's $5,000 risk and their fees and still leave a healthy profit? Yeah, in this case, it absolutely is. This deal looks solid.
But it's just as important, maybe even more important, to know what makes them say no. A shaky or unproven end buyer? That's a huge red flag. A profit margin that's just too thin? They're not going to take that risk. An exit plan that seems like a fantasy? Or just messy paperwork? Forget it. That's an instant rejection. These are the deal killers you have to solve before you even think about asking for funding. Okay, so let's say your deal makes it through the gauntlet. The funder's very next thought is pure self-preservation. I mean, how do they put up their cash without risking it all? Well, they build themselves a suit of legal armor to protect their investment.
And they usually do it in one of two ways. In a joint venture, or a JV, they literally become your partner and take a percentage of the final profit. Or in a flat fee model, they act more like a classic lender, just charging you a fixed fee for their service. For you, the investor, a flat fee is predictable. But for the funder, a JV offers a much bigger potential reward for taking on that risk.
Oh, I love this quote I heard from a capital desk manager. It just perfectly captures the whole mindset. They said, "The contract is our shield, the escrow instructions are our sword." See, the purchase contract is their main defense, but the escrow instructions, those specific directions for the person holding the money, that's their offensive weapon. That's how they control the money and make sure they get their capital back.
And these are the absolute non-negotiables. They are going to demand an assignment of contract, which gives them the right to take over the deal if you mess up. They'll file a lien against the contract itself. And on the riskier deals, you bet they might even require a personal guarantee, making you personally liable if the whole thing goes sideways. It is all about control.
So, you've survived underwriting, the deal is structured to be safe, and now we get to the best part, the payoff. This is where everybody gets what they came for.
But here's a little inside scoop. For a really sophisticated funder, the profit from just one deal, that's not actually the main prize. There's one primary goal that outweighs everything else.
For a smart funder, the real goal is, number one, a smooth closing where they get their capital back plus their fee. But what's even more important is identifying you as a reliable operator they want to do more business with. They're not looking for a bunch of one-off deals. They're trying to build a pipeline of profitable deals with partners they can trust.
And that really brings us to the final and most crucial question you have to ask yourself. When you go looking for funding, are you just looking for a simple transaction? Or are you looking for a strategic partnership that can fund your growth for years to come? I can tell you right now, the best in the business, they always choose the partnership.